Thank you very much, everyone. Merci beaucoup d'être ici aujourd'hui. Ça m'a fait plaisir d'être invité de vous adresser la parole. I'm very pleased to be here with you today. I've got to say that it is a bit intimidating to be speaking to a room full of economists, and that as a lawyer, I'm used to having people poke fun at me and the lawyer jokes, etc. So I thought, what a great way to start, maybe find a joke on economists, that I turn the tables a little bit. And I got a little concerned because when I started Googling for jokes on economists, the ones I found, I couldn't understand what they meant. So, geez, I'm in trouble. So I'd like to speak to you today about the changes that we're seeing in our industry with respect to the changes that have come as a result of the change to the Canadian Wheat Board. But I think there are more profound changes than that. And I'd like to speak to you a little bit about what those changes are from the perspective of a player on the ground that handles and exports grains. So I'll just start off by telling you a little bit about our company so that you understand kind of our viewpoint, our starting point, where we come from. Our company, James Richardson and Sons Limited, was founded in 1857. So one of the oldest Canadian companies, 10 years older than Canada itself. We're now in the 5th generation of ownership of the company. And it's Canada's largest privately owned agribusiness. Some of you who may follow the ag business might be aware that we're currently in the midst of a major transaction that involves Viterra, Glencore being a very large international company, acquiring Viterra, that is currently Canada's largest grain handling company, and then spinning off some of the assets, a big chunk of which is coming to Richardson. So as a result, following that transaction, Richardson will effectively be Canada's largest grain handling company. Our business model is one of full integration, so we're involved really at all ends of the agricultural industry sector. We're involved on the production side through crop input businesses that we operate, where we sell the inputs that farmers require to grow their crops, so chemical, fertilizer, seed. And then we also purchase back the production and accept delivery of that grain at our grain elevators across Western Canada. We also source eastern grains out of Quebec and Ontario, where those are sourced out of a marketing office that we have in Boucherville, Quebec, and the grain then delivered to a number of facilities. We have a receiving elevator in Hamilton and a transfer elevator in Sorel, Quebec, that accepts deliveries directly from Eastern Canadian producers. We then merchandise the grain from offices. Our merchants are all situated in Winnipeg. We merchandise the grain to all corners of the globe and to end-use customers. But we're also one of our largest customers because we have an oilseed processing business, 2 canola crushing plants, one in Lethbridge, Alberta, one more recently built in Yorkton, Saskatchewan, where we produce canola oil, but we also go all the way to a packaged product. Our Lethbridge plant has a packaging plant. We also have recently acquired a packaging plant in Mississauga, and we market retail-ready canola oil products, margarines, cooking oils, sprays, etc. And we also sell bulk canola oil around the world. So the changes in the grain industry. So we spoke about, and Earl mentioned the changes to the Canadian Wheat Board. I think that is one piece of a three-legged stool that signals very big changes in our domestic environment, domestic regulatory, statutory environment. The first one being Canadian Wheat Board, the other one being changes to the Canadian Grain Commission, and then rail legislation reform. So I'm going to talk a little bit about what that does domestically for us and how that helps us or potentially hinders us with respect to the international business that we do. So the Canadian Wheat Board, we think oftentimes our first reaction when we think about it is the removal of the single desk monopoly as it pertains to the producers who now have the option of marketing, selling their grain to a number of buyers in Canada. But for us, that's a little bit more, there's a little bit more to it than that. As grain merchandisers, it allows us now to add wheat and barley to our menu options to buyers around the world. And we always had this distinction previously of board grains and non-board grains. Now everything is what used to be non-board grains, and that's the way that we handle it, and that's the way that we market it. What it's meant for a company like us has been to really increase efficiencies in our grain handling system. We really had previously two types of systems operating within one pipeline. And if I could use a bit of an analogy, it'd be like if you had a transportation business that included warehouses, and you managed part of your warehouse and you managed all the deliveries of it, but somebody else was using the other part of your warehouse. The potential for conflict, for miscommunication is much higher than if you control the entire pipeline. So from a logistics standpoint, the changes to the Canadian Wheat Board, we expected, and I think it's proven, at least in our case, to be true, that we are much more efficient in the management of our elevator space, in the flow of goods to port terminal, and ultimately loading vessels and delivering to our customers. What it's also meant for us has been the ability to use what we call combination shipments. So in the past, the vast majority of wheat and barley were sold exclusively as wheat and barley shipments. So you'd load a 50,000-ton Panamax vessel of wheat, and it would go to an end-use buyer of wheat. And we would load a 50,000-ton vessel of canola, or a mix of canola and peas or canola and flax, and that would go off. Now we have the ability of loading a vessel that has 10,000 tons of canola, 10,000 tons of wheat, 5,000 tons of flax, 5,000 tons of peas, all going to an end-use destination, and being able to service the needs of buyers that might not otherwise have been able to purchase the wide and large quantities of wheat and barley that were previously being marketed by the Canadian Wheat Board. So from our perspective, we think it opens up a number of different sales opportunities that might not otherwise have been there, or might not have previously been serviced by the Canadian Wheat Board. Just a few words on changes to the Canadian Grain Commission. So there have been significant changes to the Canadian Grain Commission, and I think really the changes that have been made were an attempt to modernize the Grain Commission's role as a result of the removal of the Canadian Wheat Board monopoly. A lot of the inspection services that were mandatory mainly because of the structure that had been laid in by the way the Canadian Wheat Board operated. So the Canadian Wheat Board, owning stocks of grain in the country elevators, but not actually physically handling it, needed or wanted various checkpoints along the way in the grain handling system to monitor the quality of its stocks. Now that the grain is actually purchased by grain companies like ourselves right at delivery, and we own it and manage it throughout our grain system, the mandatory aspect of inspection has gone by the wayside. And so those costs have been removed from the system. From our perspective, however, we don't think that those changes have gone quite as far as they need to be, and we are in discussions and have been speaking about the need to pare back even further some of those requirements that continue to be mandatory. And one of the elements as well is those requirements or services that are mandatory ought to be offered in a much more price competitive fashion. Currently, the cost of the CGC services for a producer with a 5,000-acre farm would work out to about $8,000 of cost that ultimately is pushed back to the producer. So $8,000 currently. The government now moving forward with a full cost recovery policy and increased costs of services to the Canadian Grain of the Canadian Grain Commission services will essentially double those costs. So that farmer will now be looking at $16,000 that's being taken from the system as a result of those expenses. Very expensive, especially if, when you look at it from our perspective, when we deal with our international customers, those customers saying, that's all fine and well that you have those services, but if I'm comparing you to a US or Australia that don't have that layer of cost, I don't see any increased value to it, and I'm not prepared to pay for it. So it's an increased cost that the Canadian system has that we don't believe our competitors have, at least not to that full extent. With respect to rail legislation, the issue that we have with rail legislation is that it is obviously a very critical part of our logistics system, movement of grain by rail. And under the current situation where you have the vast majority of grain handling facilities being captive to one of the two major railways and not having the ability to move to another service provider in the event of poor service performance, there are no real effective consequences to a railway for performance failure. And that has been the case not just for grain, but for multiple users of the rail system in bulk. There has been a movement afoot, and ultimately the government has reacted and has advised that it will be introducing legislation that will provide shippers with level of service agreements, or the right to have a level of service agreement to which consequences would flow for failure to provide adequate service. So those are all very significant and important changes. But the question that we have to ask ourselves are they enough, and how do we ensure that we take full advantage of those potential benefits? I'm obviously not the first person that's spoken about this, and Earl made reference to it in his presentation about the growing population, the population growth and its impact on what we do. So looking at our domestic environment, especially in wheat and barley, we have historically worked on what I'll call a production push frame of mind versus instead of demand pull. So production push, producers growing their crops, their wheat and barley as they have historically, and then pushing it out into the international market, trying to find buyers for them and trying to get the highest price possible for that commodity. And as Earl mentioned previously, I think we've developed a Canadian brand. I think it's a good Canadian brand. It's branded as a high-quality wheat, and so high-quality wheat varieties. The problem with high-quality wheat varieties is that typically they come at a cost with respect to yield. And so there's a trade-off that you're making. You're trading off quality versus yield, and the question that we have to ask ourselves going forward, looking forward, is that brand, is that high-quality wheat that we specialize in, is that really what the international marketplace is looking for? And how is that going to look like as we deal with this population growth? Are we going to narrow that gap? Are we going to maintain it? Or is that gap going to grow between what we produce and what the world is looking for? So I'll have you look at two slides very quickly. So this is the areas of anticipated population growth by 2050. The darker the red color, the higher the population growth. And you'll note, obviously, the bright red comes from the African regions, the Middle East, and Asia. If you look up further north to Europe, flat to declining population growth. All right. I'll just flip to one slide further. Here is where crops are grown. And Earl made reference to this. In North America and in Canada, we're basically in the middle of the continent. We've got some distance to go to tidewater. Not a whole lot of production in those areas of population growth. And in that European region, that's where crops are being grown as well. So I'll just come back. Sorry, to this slide. So we've got, those are the areas of population growth. So looking at that map, I think the question that we have to ask ourselves is that area of population growth, what kind of wheat varieties are they likely looking for? Are they looking for the high-quality varieties for which we say we're getting a premium and that is higher priced? Are they more likely looking at lower-quality wheats that are more price competitive, more affordable? As I said, by contrast, Europe's population is forecasted to be flat, and they have strong domestic ag production themselves. And Europe has traditionally been that buyer of that high-quality wheat. And so if you were setting up your business strategy, which markets would you be targeting? Would you be looking longer term at developing a strategy that is focused towards that European market with flat population growth, their own production, and a reluctance or opposition to adopt technological change? Or would you be looking at how you serve that area of higher increased population growth for the next several decades? So the question then is, should we let the market determine what producers grow and what we export? Because as Earl mentioned, we've got a Canadian system that puts a lot of focus on that high-quality Canadian brand. We have a varietal registration system that encourages the development of those types of varieties, and we have a big gap between what are our Canadian varieties and then what falls down to feed wheat. And the question is, should we start focusing on those lower classes and encouraging the development of those lower classes that might be more attractive to those developing countries? And so when Earl was talking about that Canadian brand of high quality, I think I'd nuance that a little bit. I think that what we ought to be striving for is developing that high quality, having that high quality available for those marketplaces that are in fact prepared to pay that premium, that difference between the lack of yield for that quality. But maybe what we should be marketing ourselves as is the most reliable supplier of what you've contracted for, so that we have a variety system, we've got a handling system, a regulatory system that ensures that a buyer consistently receives what that buyer has contracted for, has the specifications that they've agreed to purchase, and we can deliver that on a regular basis. And as importantly, we can deliver it on a reliable basis in a timely fashion. And again, the timely fashion thing comes to the point where Earl was talking about. Our distance to those destinations, to that consumption, is larger than that of our competitors. And I think there is naturally a reluctance or a concern about our ability to be able to service those marketplaces in a timely fashion, especially if we have a rail system that has had difficulties in the past being able to provide reliable service to be able to meet export demands. And so those issues, I think, are on the way to being resolved from a rail approach in the changes that the government has proposed to rail legislation. Now, with respect to the regulatory regime that we currently have, from our perspective as a company that competes against a number of grain handlers and grain exporters from different countries, our sense is that our regulatory system is heavy and heavier than that exists in the countries that we compete against, and ultimately puts us and Canadian producers at a competitive disadvantage. That blue arrow that I've got there identifies the people that have very significant investment in the Canadian agricultural industry. And I think that when we're talking about the extent of regulation that we need in our industry, it always has to be focused on how is that allowing those pieces individually and that line as a whole to be as competitive or more competitive than what other countries are able to achieve. If we have regulation that doesn't allow those parts, and again, the whole, to be as competitive as it can be, and especially in comparison to other countries, then I think we're failing at our policy and regulation. Now, government isn't the only one to blame with respect to excess cost that's layered into our system. Those bubbles that we've put on that slide identify the various associations and trade groups and organizations that exist in the agricultural industry. And those are just actually a few of them. There's a number of them that probably could be subdivided by province and by commodity. We, as an industry, have layered on way too much cost to this industry. We have to find a way to remove a lot of those bubbles, not necessarily the work that's being done, but that we collaborate much closer. We, at best, are using funds and resources and time and energy inefficiently. At worst, are creating mixed messages. We're all talking to governments, we're all talking to various companies, and I think we're giving out very mixed messages. I think it's incumbent on ourselves to reorganize the way that we have organized ourselves, to reflect the fact that all of us deal with multiple commodities. We as grain handlers, producers, exporters don't deal with individual commodities, and we shouldn't keep looking at them as individual commodities. We ought to look at it as an industry. And I think that we have to remove the focus of the individual parts of the industry rather than talking about the industry as a whole.